The data we are seeing on the blockchain right now suggests a silent but massive divergence between price action and capital flows. Most retail investors are currently paralyzed by fear because they are looking exclusively at the daily price charts. The reality is that while the public sentiment has turned bearish, institutional wallets are quietly absorbing liquidity at a rate we have not seen since the accumulation phase of 2019. If you are currently holding Bitcoin or considering exiting your position to preserve capital, you are likely reacting to noise rather than signal. You are at risk of selling your assets to the very entities that engineered this flush to acquire cheaper coins. Here is why this matters to your portfolio right now. In the next few minutes, I am going to present 3 critical on-chain metrics that usually signal the absolute end of a bull market. We will compare today's data against those historical exit signals to determine if the bull run is officially dead or if we are simply in a mid-cycle shakeout. I'm going to show you exactly where the smart money has moved their stop losses and where the real liquidity walls are hiding. Let us get into the weeds. To understand if the cycle is over, we first need to ignore the headlines and look at the realized price distribution. The realized price is essentially the average cost basis of all Bitcoin moving on the network. When the market price falls below the realized price of short-term holders, we typically enter a phase of extreme anxiety. Right now, the short-term holder cost basis is sitting significantly higher than the current trading price. This means that almost everyone who bought Bitcoin in the last 6 months is currently underwater on their investment. Historically, this creates a heavy overhead resistance because as soon as the price rallies back to their break-even point, these nervous investors sell to get their money back. We are seeing a metric called the Accumulation Trend Score reaching near perfect levels. This metric tracks the behavior of large entities that have a history of buying and never selling. These entities are aggressively buying this dip, while the short-term speculators are panic selling. If the bull run were officially over, we would see these large entities distributing their coins and moving stable coins back to fiat bank accounts. That is not happening. Instead, we are seeing stablecoin dominance on exchanges actually increasing, which represents dry powder waiting to be deployed. The narrative that the cycle is finished is largely driven by a misunderstanding of market structure. People are used to the 4-year cycle operating like clockwork, with a parabolic top happening exactly when expected. The introduction of the spot exchange-traded funds has completely broken the traditional timeline. The demand shock from the exchange-traded funds pulled the cycle forward, creating an early all-time high. Now, the market is in a painful period of indigestion as it tries to reconcile that early demand with the current macroeconomic reality. This brings us to the second critical point, which is the behavior of the miners. Miner capitulation is often the final nail in the coffin for a bear market, but it can also signal the end of a bull run if it happens too late. Since the halving, mining revenue has been slashed in half, forcing inefficient miners to shut down their rigs. We are seeing their Bitcoin treasuries flowing onto exchanges, adding sell pressure. In a true bear market beginning, this miner selling would trigger a cascade of liquidations that sends the price down 50 or 60%. Yet, the price has remained range-bound. This resilience in the face of structural selling suggests that the market is absorbing the supply shock much better than it did in previous cycles. The reality is that the market is transitioning from a miner-led supply dynamic to an issuer-led demand dynamic. The selling pressure from miners is currently being offset by the passive bid from automated investment strategies. If this data is helping you stay ahead of the crowd and see the market with clarity, feel free to join our inner circle by subscribing for more deep dive intelligence. Now, we need to talk about the liquidity crisis that no one is discussing. When we look at the order books across major exchanges like Coinbase and Binance, liquidity is thinning out. Thin liquidity means that it takes less capital to move the price significantly in either direction. This is why we are seeing such violent volatility and scam wicks that liquidate leveraged traders. During the end of a bull market, liquidity usually dries up because interest in the asset class vanishes. However, the current liquidity thinning is happening because coins are moving off exchanges into cold storage. The exchange balance of Bitcoin is hitting multi-year lows. There are fewer coins available for sale today than there were at the start of the year. This is a supply squeeze in the making. If demand remains constant or increases even slightly, the lack of available supply on exchanges must mathematically force the price upward. The bearish argument relies on demand collapsing, but the user adoption metrics show the exact opposite. The number of active addresses with a non-zero balance is continuing to trend upward, albeit slowly. We are not seeing the mass exodus of users that characterizes the true end of a cycle. In 2018 and late 2021, active addresses plummeted as retail investors left the space in disgust. Today, those network activity numbers are sticky. This implies that the core user base has not left. They are simply dormant, waiting for a direction. Let us discuss the macroeconomic backdrop, because Bitcoin does not exist in a vacuum. The previous bull runs ended when the Federal Reserve aggressively tightened monetary policy. Currently, we are in a pause period with expectations of rate cuts on the horizon. Global liquidity is starting to expand again, led by central banks in Canada and Europe. Bitcoin is highly correlated with global M2 money supply growth. When the global money supply expands, risk assets like Bitcoin are the first to run. To declare the bull run over right now would be to bet against the global trend of monetary debasement that is just restarting. The smart money knows this, which is why they are not selling their core positions. They are hedging, they are rebalancing, but they are not exiting. Another factor we must consider is the psychological state of the market. Market tops are typically marked by euphoria, where everyone is a genius and grandmothers are asking how to buy altcoins. We are currently in a state of apathy and depression. Sentiment metrics like the Fear and Greed Index have been flashing fear for weeks. Markets rarely top out when everyone is scared. They top out when everyone is greedy. This sentiment structure is much more aligned with a mid-cycle reaccumulation range than a cycle top. It feels painful because it is boring and choppy, which is designed to shake out the impatient capital. Here is why this matters for your strategy. If you sell now, you are validating the strategy of the institutions that are buying your coins. However, we must also look at the invalidation points to remain objective. If Bitcoin were to lose the weekly support level at the 200-week moving average, the conversation would change. That level has historically been the final line in the sand. Currently, we are trading well above that level, maintaining the macro bullish structure. The death of the cycle narrative is premature and largely emotional. We are seeing a rotation of capital from old coins to new investors, which is a healthy, albeit slow, process. The realized cap of the entire network is still making new all-time highs. This means that capital is still flowing into the network on a net basis. In a true bear market, the realized cap trends downward as capital flees the system. The fact that the realized cap is rising while price is stagnant indicates that coins are changing hands at these high prices, establishing a new floor. This is capital entrenchment, not capital flight. If you appreciate this level of unbiased, data-first analysis that cuts through the hype, please take a moment to like this video so we can keep bringing you these insights. So, where does this leave us? The data suggests that the easy phase of the bull run is over, but the bull run itself is not. We have moved from the up-only phase into the PvP, or player versus player phase. In this phase, the market punishes over-leverage and rewards patience. The expectation of a vertical, parabolic run might need to be adjusted to a slower, more grinding appreciation. The presence of institutional heavyweights dampens volatility, meaning we might not see the same 10,000% returns, but we also have a safety net against 90% drawdowns. The cycle is lengthening, not ending. We are likely witnessing the maturity of the asset class, where it behaves more like the NASDAQ and less like a penny stock. This transition is confusing for investors who are used to the casino-style dynamics of previous years. But confusion is not a sell signal. The on-chain signals regarding whale accumulation, exchange outflows, and realized cap growth all point to a market that is coiling, not collapsing. The smart money is betting on a resurgence of liquidity later this year. They are positioning themselves before the headlines change. By the time the media announces that the bull run is back on, the smart money will have already finished buying. Your job is to align yourself with the flow of capital, not the flow of opinions. Here is the playbook for the coming weeks. Watch the short-term holder cost basis carefully. If we reclaim that level, it will act as a launch pad for the next leg up. Until then, expect chop and manipulation designed to test your conviction. Do not use leverage in this environment, as the market makers are hunting liquidity on both sides. Focus on spot accumulation and ignore the intraday noise. The structural fundamentals of the network are stronger than they have ever been. Hash rate is high, security is robust, and institutional adoption is accelerating behind closed doors. Patience is the only edge you have left against the algorithms. Use it. Please note that I am not a financial advisor. The content presented in this video is for informational and educational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. Nothing contained in this video constitutes a solicitation, recommendation, endorsement, or offer by me or any third-party service provider to buy or sell any securities, or other financial instruments. Investing in cryptocurrencies involves a high degree of risk, and there is always the potential of losing money when you invest in financial products. Always conduct your own due diligence and consult with a qualified financial professional before making any investment decisions.